What if the same $100 could create two completely different financial futures? In one, it disappears into a normal month. In the other, you invest $100 every month for 40 years. At first, the difference is almost invisible, and that is exactly when most people underestimate what time can do. So we're going to simulate what happens when you invest $100 a month for 40 years, then change one variable at a time. Start 10 years later, change the return by 1 percentage point, test the plan against a market crash, and finally see what happens when compounding starts working for the lender instead of for you. This isn't a prediction or a promise. Think of it as a financial time machine. It cannot tell you exactly what your future will be, but it can show you the direction repeated money decisions are capable of taking you. So here are the starting rules. $100 invested every month for 40 years, using a hypothetical 7% annual return with monthly contributions and compounding. For simplicity, we are ignoring taxes, fees, and inflation, and none of these returns are guaranteed. The goal is simply to isolate three forces: time, consistency, and compounding. In the first year, our investor contributes $1,200. If you were watching the graph, you might be disappointed. The line barely moves. Nothing looks life-changing. That is where beginners can misunderstand compounding. The first years are not there to impress you. They are there to build the base. Like planting a tree, the visible growth can look small while the foundation underneath is developing. After 10 years, this investor has contributed $12,000. The account is growing, but emotionally, 10 years can feel like a long time for something that still does not look extraordinary. People begin wondering whether such a small monthly contribution is really worth continuing. But 10 years into a 40-year simulation is only 1/4 of the journey. Keep the clock moving. By year 20, the account has more momentum. By year 30, the curve becomes noticeably steeper because growth is no longer coming, only from new contributions. Previous growth has had time to create additional growth. Then we reach year 40. Total amount contributed, $48,000. Simulated ending balance, approximately $262,481. Again, this is only the simplified simulation. But notice what happened. The investor did not contribute $262,000. They contributed $48,000. The difference came from allowing consistent contributions and time to work together. That is the first lesson. Small money can become meaningful when repetition gives it enough time. Now let's change only one variable. The first investor starts at age 25 and invests $100 every month until 65. 40 years. The second waits until age 35 and invests the exact same $100 a month until 65. 30 years. Same monthly contribution. Same hypothetical 7% return. The only change is when they begin. The early starter finishes at approximately $262,481. The person who waits 10 years finishes at approximately $121,997, a difference of roughly $140,000. And here is what makes that important. Waiting 10 years does not only cost the contributions you failed to make, it costs the growth those contributions never had time to create. That is the hidden price of later. This is not about shaming anyone who could not start earlier. Low income, debt, housing costs, family obligations, and emergencies are real. The lesson is simply to respect time when you have the ability to use it. Compounding needs time more than it needs a perfect beginning. Now change another variable. Go back to $100 a month for 40 years. At 7%, the simulated ending balance is roughly $262,000. Change the hypothetical return to 8%, only 1 percentage point higher. The ending balance becomes approximately $349,000. That is a difference of about $86,000. 1 percentage point sounds small today. Repeated for 40 years, it does not stay small. That is why seemingly small differences in net returns whether caused by fees, costs, or investment performance, can matter enormously over long periods. But there is an important warning here. This does not mean you should chase any investment promising a higher return. Higher expected returns can involve higher risk, and higher risk can mean larger losses. The better lesson is to control what you can control. Keep unnecessary costs low, diversify appropriately, increase contributions when your income allows it, and remember that decades can magnify differences that look insignificant today. So far, this simulation has mostly tested patience. Now let's test something harder: behavior. Imagine that halfway through the 40-year journey, the market falls 35%. The graph drops sharply. Years of visible progress suddenly look damaged. For this part, we are not going to predict exactly how or when the market recovers. We are testing something else. Can the investor's financial plan survive the fear? Because this is where investing stops feeling like mathematics and starts feeling emotional. The natural reaction may be, "This is not working. Maybe I should wait until things feel safe again." That fear is understandable. No one enjoys watching an account fall. A crash matters. Losses are real. Recovery is never guaranteed. But a downturn reveals whether the financial plan was designed to survive uncertainty. That is why long-term investing needs a foundation. Emergency money should not be invested in assets that may fall sharply. Rent money should not be invested. Money you need next month should not depend on what the market does tomorrow, because if you need that money during a downturn, you may be forced to sell when prices are already down. Long-term money has a different time horizon. When the financial foundation is strong and the money is genuinely long-term, the investor has more ability to stay with the plan instead of reacting entirely to fear. The market does not only test your portfolio, it tests your behavior. Now let's flip the simulation completely, because compounding does not care whose side it is on. It can work for you, or it can work for the lender. Imagine someone has $30,000 of debt at an 18% APR. If that debt is paid aggressively over 2 years, the monthly payment is painful, but total interest is approximately $5,945. Now stretch that same debt over 10 years. The monthly payment becomes much easier, but total interest rises to approximately $34,867. That is the trap. The cheaper monthly payment can become the more expensive life. A borrower can feel responsible because the payment is being made every month. The account stays current. There is no default, but interest keeps working underneath the payment, slowing progress and increasing the total cost. That is what high-interest debt can do. It turns time from an ally into an enemy. And this is why aggressively reducing high-interest debt can sometimes be one of the strongest financial moves available. Not because investing is bad, but because high-interest debt creates a known borrowing cost, while future market returns remain uncertain. Every dollar no longer going toward unnecessary interest is a dollar that can eventually save, invest, protect, or build. So the real wealth simulation is not only asking how much your investments can become, it is asking which direction is your money compounding. Now, one final question. Does this mean every spare dollar should be invested? No. Imagine 2 people each set aside $100 a month for 40 years. In our simplified zero-growth cash scenario, the first person simply stores the money. After 40 years, that is $48,000. The second invests the same amount using our hypothetical 7% return. The simulated result is approximately $262,481. That does not make cash useless. Cash simply has a different job. Emergency savings need stability and accessibility. Cash can help cover unexpected expenses and prevent a temporary problem from becoming expensive debt. Long-term money has a different objective. Saving stores money. Investing gives long-term money growth potential while accepting investment risk. The mistake is not having cash. The mistake is asking one financial tool to do every job. Some money protects you, some reduces debt, some invests for the future, and some creates opportunities. Wealth building becomes clearer when every dollar has a purpose. And that is what the simulation ultimately shows. The deepest lesson is not any single ending balance. It is what repeated decisions can become when time keeps multiplying their effects. Starting earlier gives compounding more room to work. Small differences in long-term returns can become meaningful over decades. High-interest debt can make the same force work against you. And emergency savings can help protect a long-term investment plan from short-term financial pressure. Long-term wealth rarely comes from one perfect move. More often it grows from ordinary decisions that looked unimpressive while they were being made. So if you're thinking, I should have started earlier, do not turn regret into another reason to delay. You cannot invest yesterday. You can only decide what happens next. Start with an amount that realistically fits your life. Maybe it is $10, $25, $50, or $100. The first goal is not to pretend the amount is larger than it is. It is to establish a decision you can repeat. Then, as your income and financial position improve, the amount can grow. And remember what this simulation is. Not a guarantee. A mirror. It shows what small financial decisions can become when they are repeated. Those decisions can compound toward greater freedom, or they can compound toward regret. The difference is direction. So before the next dollar quietly disappears into another ordinary month, ask yourself, what future is this dollar voting for? Because one of the most expensive financial decisions may be the one that feels harmless today. And one of the most powerful may be the small decision you finally decide to repeat. Which part of the simulation surprised you most? The 10-year delay, the 1 percentage point difference, or the debt comparison? Share it in the comments. And subscribe to Financial Awaken with Aaron for practical financial education that helps you understand the systems behind long-term wealth.